Right. Get ready for this deep dive. We're going to unpack corporate finance. Like how companies make those big money decisions.
Yeah. Whether it's launching a new product or buying another company, it's a world where everything's connected. Companies need money to grow, investors looking for the best place to put their cash, a real financial ecosystem.
Okay, so let's map this ecosystem out. We've got companies, they've got the big ideas, big dreams, but they need capital to make it happen.
Right, and that's where institutions come in, pension funds, insurance companies, even everyday people investing.
Right.
They've got the capital companies need.
So they don't just randomly, run into each other at the coffee shop and swap cash for stocks or something, do they?
Not quite. No, that's where investment banks step in. They're the matchmakers,
Yeah.
connecting companies with investors, keeping the money flowing.
Mhm.
And then you have the unsung heroes, the public accounting firms, making sure everything is by the book, rules and regs.
So it's like a complex dance. Everyone plays their part. But companies aren't static. They go through different phases, kind of like life stages?
Exactly. We call it the business life cycle. It starts with the launch, full of energy and potential. Then a growth phase takes off, sales are booming, exciting time.
Yeah. And then comes the shakeout, right? Things get really interesting. Competition heats up. Not everyone survives this.
It's a critical point. Just like people, some thrive under pressure, businesses, they emerge stronger.
Right.
They reach maturity as steady state. But even the most successful companies, they can eventually decline.
So how does understanding this life cycle help us, the average investor, make better decisions?
It helps you assess a company's potential. You want to look at sales, profit margins, cash flow.
Mm-hmm.
Are they growing? Are they sustainable? These numbers tell a story.
Okay. Makes sense. So let's talk about where the real action is, capital budgeting. Companies decide which projects are worth investing in.
Absolutely. It's about those strategic decisions shape the future of the company. Could be a new product, a factory, even acquiring another company, big bets.
So how do they decide which projects to pursue? You can't just be gut feeling, throw a dart at a board.
Right. Well, there's a process steps they go through.
Yeah.
First they estimate cash flow. The project is expected to generate. How much money will it bring in?
Right. I bet that involves a lot of projections and maybe a little bit of, finger crossing.
Definitely. And they have to consider the risk involved. Some projects are riskier than others.
Makes sense. So they look at the potential cash, factor in the risk, and then what?
Then they bring it back to the present, calculating the present value of those future cash flows. Money today is worth more than money in the future.
Got it.
Got to account for that.
Okay, I'm following. So they compare the present value of those future earnings to the cost of the project.
Exactly. If the potential return outweighs the cost, it's a green light, all about maximizing value for the company and its shareholders.
So capital budgeting is about weighing the potential rewards against the risks.
Precisely. Think of a tech company deciding whether to invest in developing AI. Huge payoff, massive costs, no guarantee of success, or a retail chain expanding into a new market.
Right.
Weigh the profits against the upfront investment.
It's like a giant game of financial chess.
You could say that. And speaking of money, companies need to figure out where to get the funds for these ambitious projects. That brings us to capital structure.
Okay, so we know they need money. Where do they go to get it?
Couple of main avenues. They can take out loans, debt financing, or they can issue shares of stock, equity financing.
So it's like building a house, savings for down payment, that's your equity. Get a mortgage to cover the rest, that's your debt. Companies do the same thing.
Exactly. And just like with a house, companies need to figure out the mix of debt and equity. We call this their capital structure.
Right, and that balance can make a big difference. Too much debt can be risky.
It can be if a company takes on too much debt and can't make the payments, could face financial trouble. But relying just on equity also has downsides, dilutes the ownership stake.
So finding that sweet spot, that right balance, is crucial.
Absolutely. Minimizing the cost of raising capital while managing risk.
Now, this talk about raising capital, the value of companies, how do we even determine what a company is worth, especially if it's not publicly traded?
That's where business valuation comes in, an art and a science.
Okay, lay it on me. How do we unlock the secrets of valuation?
Well, there are a few key techniques. One is comparing the company to similar publicly traded companies, like checking house prices, to gauge what your home might be worth.
Makes sense. So it's all about finding those apples-to-apples comparisons.
Right. Another approach is looking at past acquisitions. We call these precedent transactions. Helps us see what buyers were willing to pay.
So it's like checking the sales history to see what houses have sold for.
Exactly. Now, the third method is a bit more complex, but it's considered the gold standard discounted cash flow or DCF analysis.
Okay, DCF analysis sounds intriguing. What's the idea behind it?
With DCF, we're trying to peek into the future. We project the company's future cash flows and then discount them back to the present value. Remember that concept?
Right. Money today is worth more than money tomorrow, so DCF analysis gives us a glimpse into a company's financial future.
Exactly. Helps us estimate the intrinsic value of a company, what it's really worth, based on its ability to generate cash in the future.
Okay.
Now, there's another important concept that often comes up in business valuation, especially with mergers and acquisitions.
I'm all ears. Tell me more.
It's the idea of synergies.
Synergies. I've heard that word thrown around. Not sure what it means.
Synergies refer to the extra value created when two companies combine. It's not just adding their individual values together. Sometimes 1 + 1 = 3.
So the whole is greater than the sum of its parts.
Exactly. Imagine two puzzle pieces fitting perfectly together. That's synergy.
Makes sense. So when companies merge, they're hoping to unlock these synergies, those hidden sources of value.
Precisely. Synergies can come from cost savings, increased market power, or cross-selling products. They're a key driver of M&A activity.
Okay, so now that we've talked about synergies, I'm curious about the M&A process itself. Why do companies go through all the trouble of buying other companies?
Many reasons. Sometimes it's about gaining access to new markets or technologies. Other times it's about consolidating the industry, becoming a bigger player.
So it's all about expanding those corporate empires. Can you walk us through the steps involved in a typical acquisition?
Well, it starts with a strategy. What kind of company are we looking for and why? Then the search for potential targets, followed by valuation and negotiation.
Right, and I bet those negotiations can get pretty heated, especially if you've got, multiple companies vying for the same price.
Absolutely. Billions of dollars at stake. Once the terms are agreed upon, there's due diligence, like a thorough home inspection. Want to make sure there are no hidden surprises.
Right. Don't want to discover cracks in the foundation after you sign the papers.
Exactly. And then finally, the big day arrives. The acquisition is finalized.
But the work doesn't stop there.
No, you're right. Integrating two companies, especially with different cultures and systems, that can be a challenge.
It's like blending two families together. Takes time, patience, and a lot of communication.
That's a great analogy. And of course, the success often hinges on whether those synergies materialize.
So it's a gamble, but with potentially huge rewards if it's done right.
Yeah.
But we haven't even talked about how these mega deals are financed. Where does all the money come from? For these acquisitions, it's not like companies just have billions lying around.
Well, right. That's where we enter the world of acquisition financing. It's like building a skyscraper. You wouldn't rely on just one type of material.
Right.
You need a combination: steel, concrete, glass.
So acquisitions are financed using a mix of funding sources, just like our skyscraper analogy.
Precisely, we call this mix. The capital stack represents the layers of financing, each with different levels of risk and return. At the base, the foundation is senior debt.
Senior debt. That sounds familiar.
Yeah, it's the safest, least expensive type of financing, usually secured by the assets of the company being acquired.
So it's like a rock-solid foundation. What else goes into this capital stack?
Above senior debt, you might find subordinated debt, which is riskier and carries a higher interest rate.
So if senior debt is the foundation, subordinated debt is maybe the framing of our skyscraper. Little less secure, but still essential.
Haha, that's a great way to visualize it. And then at the very top, the penthouse suite of our capital stack, we have equity.
Equity, the ownership stake. So that's the part with the highest risk, but also the potential for the biggest payoff.
Exactly. It's like investing in a high-growth startup. The risk is high, but the potential reward is enormous.
Okay, this capital stack is making sense, but where do private equity firms fit into all this? They're known for using leverage, borrowing money to boost their returns. I'm still a little fuzzy on how that works.
Let's imagine a scenario. Private equity firm wants to acquire a company worth, let's say, $100 million. They might put down $20 million of their own money, that's their equity, and borrow the other $80 million.
So they're using a fraction of their cash to control a much larger asset, like putting a small down payment on a house and letting the bank finance the rest.
You got it. Now let's say they increase the company's value to $200 million over a few years. When they sell it, they repay that $80 million debt and pocket the remaining $120 million. Their initial $20 million investment has turned into a six-fold return.
Wow, that's impressive. But using that much debt also seems incredibly risky.
Absolutely. Leverage is a double-edged sword. If the company's value declines instead of increases, they face significant losses.
So it's a high-risk, high-reward strategy.
Exactly. And that's why understanding leverage is crucial, can be a powerful tool for growth and returns, but needs to be managed carefully.
Speaking of debt, let's take a closer look at that. We know there's debt financing involved in acquisitions,
Yeah,
but I imagine there are different types of debt, right? Not all debt is created equal.
we're absolutely right. There's a whole spectrum of debt instruments out there, and understanding these nuances is key to navigating this world.
Okay, so I'm ready to dive deeper into this world of debt. Unpack it for us. What are some of the key types of debt that companies use?
Well, we've talked about senior debt, which sits at the top of the pecking order. It's secured by assets, lower interest rates usually provided by banks.
So the most conservative, low-risk form of debt. What else is out there?
Then you have subordinated debt, which, as the name suggests, ranks below senior debt in terms of priority of repayment.
So it's a bit riskier for the lender.
Exactly. And because of that added risk, it comes with higher interest rates to compensate. Subordinated debt is often used to fill the gap when a company needs more capital than banks are willing to provide.
Okay, I'm getting a clearer picture here.
Yeah.
We've got our low-risk senior debt, our higher-risk subordinated debt. But how do companies figure out how much debt they can actually handle?
That's a crucial question, and it all comes down to assessing their debt capacity.
Debt capacity, it's like figuring out how much weight you can lift at the gym, don't want to overdo it and risk injury.
Haha, that's a great analogy. Companies need to find that balance between using debt to fuel growth and avoiding excessive risk that could lead to financial trouble.
So how do they go about determining that sweet spot, that optimal amount of debt they can handle?
They consider a number of factors, including the stability of their earnings, overall economic climate, and existing debt levels.
Okay, let's break those down. What do you mean by stability of earnings?
Companies with predictable, consistent earnings are generally seen as more creditworthy and can handle more debt.
So a company with volatile earnings, like a tech startup, might want to be more cautious about taking on debt.
Precisely, they might not have the same level of certainty about future cash flows.
Makes sense. Now, how about the economic climate? How does that factor in?
Well, during economic downturns, lenders become more risk-averse. They might be hesitant to lend even to companies with solid earnings.
So it's like battening down the hatches during a storm. Everyone becomes more cautious.
Exactly. Now, the third factor was existing debt levels. Companies with a mountain of debt already might find it harder to borrow more.
Right?
Lenders look at a company's debt-to-equity ratio. How much debt they have compared to their equity to assess leverage. A high debt-to-equity ratio can be a red flag.
So it's all about striking that balance, managing risk, and making sure the company can comfortably handle its debt obligations.
Absolutely. Debt can be a powerful tool for growth, but it needs to be used responsibly and strategically.
Well, this deep dive into debt has been eye-opening. We've covered a lot of ground, different types of debt, to the factors that influence a company's ability to borrow.
We've only scratched the surface, but hopefully you have a better understanding of how debt plays a crucial role in the world of corporate finance.
Stay tuned, because in the next part of our deep dive, we'll explore even more fascinating corners of the corporate financial world.
Yeah, looking forward to it.
Welcome back to our deep dive.
Yeah.
You know, in the last part, we talked about the key players, the business life cycle, capital budgeting, even touched on debt and acquisitions.
Right. We saw how companies make those big money decisions, how they get funding, how we even figure out what a company is actually worth.
It's fascinating stuff. Now, I'm curious about, that moment in a company's life cycle. The IPO, when a company goes from private to public, makes their grand debut on the stock market.
Exactly. The IPO, or initial public offering, it's a major milestone for a company. Allows them to raise capital from a wider pool of investors, increases their visibility and credibility.
But I imagine it's not as simple as, just waking up one day and saying, hey, let's go public.
Right?
So what are some of the things companies think about when they're planning an IPO?
One of the biggest challenges is pricing the IPO.
Right.
Companies want to maximize the money they raise, but they also want to make sure the stock does well once it starts trading.
So they need to find that sweet spot, a price that's attractive to investors,
Yeah.
but also reflects the true value of the company.
It is. It's a real balancing act.
Yeah.
Set the price too high, scare off investors, lead to a disappointing debut.
Right.
Price it too low, and you leave money on the table.
So how do they find that magic number? What goes into determining the IPO price?
Well, they rely on a number of factors, the company's financial performance, growth prospects, and the overall market conditions. They'll use those valuation techniques we talked about earlier, DCF analysis, comparable company analysis, precedent transactions.
So it's not just a numbers game. There's some, intuition and experience that goes into this as well.
Absolutely. And that's where investment bankers play a key role. They act as advisors and underwriters. They guide the company through the process, help determine the optimal price range.
Speaking of investment bankers, I've heard they can command some pretty hefty fees for their services. Are those fees part of what we call transaction costs in, M&A deals?
You're exactly right. Transaction costs are those hidden expenses that eat into the value of a deal.
It's like buying a house.
Yeah.
You got to factor in closing costs, appraisal fees. It's not just the sticker price.
Precisely. And those costs can be significant in mergers and acquisitions. We're talking investment banking fees, but also legal fees, accounting fees, all the costs associated with due diligence and actually closing the deal.
So companies need to factor these costs in when they're, making decisions about M&A.
Absolutely. Weigh the potential benefits of a merger or acquisition against the costs. Make sure they're getting a good deal.
Okay, now we've talked about valuation, mergers and acquisitions, IPOs. All these things involve a lot of analysis. This is where financial modeling comes in, right?
You got it. Financial modeling. It's an essential tool for anyone in corporate finance. Allows you to analyze data, project future performance, evaluate those investment decisions.
I got to admit, the term financial modeling always sounds a bit intimidating to me.
Haha.
Can you break it down? What does it actually involve?
Well, at its core, financial modeling is about building spreadsheets, often very complex ones that simulate different scenarios.
So you're creating like a virtual financial lab where you can experiment.
Exactly. You can test different assumptions, see how different factors might play out, and ultimately make more informed decisions.
And I imagine that's super useful when you're, making those high stakes decisions in the corporate world. So can you give us some examples of how this is actually used?
Sure. In capital budgeting, for example, financial models can help companies project the cash flows of a potential project, calculate its net present value, and figure out if it's likely to be profitable.
Right. So it's a key part of that decision-making process we talked about earlier.
Exactly. And financial modeling is also crucial in mergers and acquisitions. Helps companies value potential targets, estimate those synergies, and analyze different deal structures. It's like having a crystal ball that can help predict the outcome.
And what about IPOs? Does it come into play there as well?
Absolutely. In an IPO, you might use financial modeling to project the company's future performance, figure out a good price range for the offering, and assess investor demand.
So it helps companies put their best foot forward when going public. So it sounds like financial modeling is a pretty valuable skill to have in corporate finance.
You're right. It's a highly sought-after skill, whether you're in investment banking, private equity, or corporate development.
So anybody listening who's thinking about a career in finance, this is something to, add to your toolkit.
Absolutely. It's a skill that can open up a lot of doors, and it's something that, you'll use throughout your career.
Great. Now, one theme that keeps coming up in our conversation is debt. We talked about it with acquisitions, but it plays a much broader role in how companies operate.
You're right. Debt is a fundamental part of how companies operate and grow.
Right.
Understanding the different types of debt and how they're used is really key to understanding corporate finance.
Okay, so I'm ready for a deeper dive into the world of debt. Can you walk us through some of the key types that companies use?
Well, we already talked about senior debt and subordinated debt, but within those categories, there's a whole range of instruments, each with its own features and terms.
All right, let's break it down. What are
Yeah.
some examples?
Well, let's start with senior debt. One common type is a revolving credit facility, essentially like a corporate credit card.
So it gives companies, flexible access to funds when they need them.
Exactly. They can draw down and repay on a revolving basis. Great tool for managing short-term cash flow needs or unexpected expenses.
Makes sense. So if a revolving credit facility is like the corporate credit card, what's like the, traditional loan?
That would be a term loan.
Yeah.
Term loans are usually for financing specific projects or acquisitions and have a fixed repayment schedule.
So it gives them a structured way to borrow for those, larger investments.
Precisely. Now let's talk about subordinated debt. As we said, it's riskier than senior debt, so it comes with higher interest rates.
Okay, what are some common examples of subordinated debt?
One you've probably heard of is high-yield bonds, sometimes called junk bonds.
Junk bonds, those don't sound too safe.
Well, they can be risky, but they offer higher potential returns. They're often issued by companies with lower credit ratings or in industries that are considered more speculative.
So they're kind of like the venture capital of the debt world.
Haha, that's a good way to put it. They're for investors who are willing to take on more risk for the potential of higher returns.
What other types of subordinated debt are out there?
Another one is mezzanine debt, sits somewhere between debt and equity in terms of risk and return.
Mezzanine debt. That's a new one for me. How does that work?
Mezzanine debt is often used to finance acquisitions or leveraged buyouts. It has a higher interest rate than senior debt, but also gives the lender the option to convert their debt into equity if the company performs well.
Hmm. So it's kind of like a hybrid, offers the lender both fixed interest payments and a chance to share in the growth of the company.
Exactly. It's a way for lenders to share in the upside potential while also having some downside protection with those fixed payments.
Okay, I'm starting to see how complex this world of debt can be. It's not just about borrowing money, it's about choosing the right type of debt for the situation.
That's right. There are a lot of factors to consider.
Right? So with all these different options, how do companies figure out, which type is the best fit?
Well, they consider a bunch of factors: the cost of the financing, the maturity of the debt, the level of risk they're comfortable with, and the flexibility they need.
So it's about finding the right tool for the job,
Mm.
just like a carpenter, choosing the right saw or hammer.
Exactly. And of course, they have to make sure they can actually repay the debt. That's where debt capacity comes in again.
Right? We talked about that earlier. So how does it apply to, these different debt instruments?
Well, each type has its own criteria that lenders look at to assess a company's ability to repay. It's like applying for a mortgage. Lenders want to make sure you have stable income, good credit history, and enough financial cushion to make those monthly payments.
So lenders are really acting as gatekeepers, making sure companies are worthy of receiving their funds.
Uh-huh, you could say that. And they use a lot of different metrics to make this assessment: financial ratios, cash flow projections, even the management team's track record.
It's a pretty thorough evaluation of a company's financial health.
Absolutely. And if a company can't make its payments, well, it could face some serious consequences: financial distress, even bankruptcy.
So managing debt responsibly is really key for a company's long-term success.
You're right. Debt can be a powerful tool for growth,
Mhm.
but it has to be used wisely and strategically.
Well, this deep dive into the world of debt has been really fascinating. We've gone from senior and subordinated debt to junk bonds and mezzanine debt.
Yeah, we've seen a lot of different flavors of debt, the factors lenders consider, and why it's so important to manage debt well.
Now, this has been an incredible journey through corporate finance, but we're not done yet.
Right.
There's still more to explore.
Yeah, stay tuned for the final part of our deep dive, where we'll look at some of the bigger issues companies have to grapple with in the world of finance.
All right, welcome back to our deep dive final part. We've gone from that high-level view of the financial ecosystem all the way down to, the nitty-gritty of debt.
Yeah, really unpacked how companies make those decisions, how they raise capital, value businesses, even how they deal with those mergers and acquisitions.
It's been a journey, but, before we wrap up, I'd love to touch on some of those, bigger challenges that companies face in managing their finances.
Yeah, it's a good point. Corporate finance isn't just about the numbers, it's about making those smart decisions in a world that's always changing.
Right. And we've talked about transaction costs in those M&A deals, those hidden fees that can really, make or break a deal.
Hmm.
Any tips for companies when they're trying to, navigate those waters?
Well, due diligence is key. Companies need to really vet those targets, scrutinize the terms of the deal, and be ready to walk away if it doesn't make sense.
It's like buying a used car. You don't just hand over the cash without looking under the hood.
Exactly. Got to do your homework.
Now, another theme that's come up is financial modeling. Seems like a pretty crucial skill for anyone in corporate finance.
Absolutely. And as the financial world gets more data-driven, that ability to build and interpret those complex models, it's really more valuable than ever.
And it's not just about plugging numbers into a spreadsheet. Got to understand those assumptions, the relationships between variables, and how different factors can impact the outcome.
Right. It's a powerful tool, but it's only as good as the information you put into it?
Garbage in, garbage out.
Exactly.
So for anyone listening, who's thinking about a career in finance, mastering this is essential.
Hey, it really is. Can open doors to a lot of opportunities. And it's a skill that requires, both that technical expertise and a solid grasp of those business fundamentals.
Well, we reached the end of our corporate finance adventure. I feel like we've really unpacked how companies make those financial decisions, everything from day to day to those big transformative moves.
Yeah, it's been great.
Hopefully everyone listening has learned a thing or two that they can apply to their own financial journey. Whether you're an investor, an entrepreneur, or just someone who wants to be more, financially savvy.
Right, because, the world of finance, it's always changing, always something new, to learn new challenges, to tackle new opportunities.
So stay curious, stay informed, and never stop learning.
Couldn't have said it better myself.
Well, thanks for joining us on this deep dive into corporate finance. Until next time, happy financing.